Hi guys. Okay, I want to go ahead and take a look at the Chapter 19 practice midterm in case you might have a question about a few of these. Pretty straightforward set of questions on our deferred taxes. Okay, so let's just look at this first one, and they start to lay out some information for this Tringali Corporation's first year of operations. And the way they're presenting this is different elements of their pre-tax accounting income. That's their GAAP income, right? The permanent difference that is $15,000, and then a temporary difference on depreciation, $20,000. Again, I'm not going to get into expecting you to know details about tax law and what would be a permanent versus temporary difference. I'll just call them out as such as I test you on this material. So the first thing they want to know, if the tax rate is 25%, what is going to be the income tax payable? Well, remember we said several times that income tax payable, of course, is going to be your taxable income times your tax rate. And so we go ahead and do the math on that, and we get this 265,000 times the 0.25 tax rate gives us the 66,250 choice C here. Again, that's what they're going to send to the IRS, right? So that's always our taxes payable liability, right? Now you come over and we look at the same set of information, but now they want to know, well, what would generate the deferred tax liability? Okay, so what's going to be that deferred portion? And so now we start to take a look and we say, well, look, we have this permanent difference. Permanent difference we should ignore. I don't know why I'm going back up to that question. Same information is here. Permanent difference, we're just going to ignore that because permanent differences don't generate a deferred tax asset liability. Here we have this temporary difference. Apparently they were able to take a deduction for depreciation for tax purposes that they won't take an expense until a future period. So they're not paying as much tax. At some point, that will turn around and they will have to owe that tax at a later time. So that 20,000 temporary difference times the 0.25 tax rate is going to give us 5,000. Okay, that 5,000, make my parenthesis, my comma a little more prominent there. That 5,000 then will end up being my deferred tax liability. You can see choice D there. Okay, good. And they gave us the calculation there as well. So now you come and third question in a row now with this set of information, and now they want us to tell, well, what's the tax expense? Well, the tax expense, of course, is going to be what? The two amounts that we've calculated here, the 66,250, right, which was the payable, plus the deferred portion, which was what? The deferred portion is the 5,000 from the previous question. You add those two together, you get the 71,250 is the tax expense, which is basically based on our income after you have backed out the permanent difference that we'll never have to pay tax on, whatever that permanent difference is. Maybe it's some sort of municipal bond income or something. Again, I'm not going to test you on specifics of tax law. I just need you to understand how the permanent differences affect your deferred tax and, of course, your tax payable that we saw in those two questions. Okay, so let's go ahead and let's take a look at number 4 now. And we've got number 4 with this company's operations in 2021. And for some property sales, Isaac recognizes income in the period of sale for financial reporting purposes. However, for income tax purposes, ISIC recognizes income when it collects cash from the buyers on these sales. So then they go ahead and they say, well, if the 600 million is sales, the only amount that is actually collected in 2021 is 60 million. This remaining, and if this total is 600 million, this remaining 540 is going to be what collected in future years, right? And therefore taxed in future years. Okay, so we go ahead and we say, well, if our tax rate is 25%, we take that 25% times that amount that will be collected and therefore taxed in future years. That gives us a deferred tax liability for this one of 135 million. Again, we're going to finally pay the tax on that in future periods when we actually collect it, even though we've taken it as income for GAAP purposes this year. Okay, good. Let's take a look at this next one now, number 5, that continues on the next page. And we have some information here. And we have applicable tax rate at 25%. And they want us to take a look at what is the deferred tax. Well, they're asking us what we should report here for our well, they ask us quite a bit of different things, whether it should be current, non-current, etc. So you start to take a look here at this one now. Okay, so when we look at this, now notice they're asking us, can we call out the current and deferred portion of our tax expense for the period. So the first thing that we're doing is saying, well, what is the tax expense period? And then we'll be able to talk about the current and deferred portion. And notice they have pre-tax accounting income of 195. And then they have this overweight fines. Okay, they're getting fines for being overweight. I guess they went to overweight in terms of some tonnage or something for their shipping, I guess. Okay, and so what happens? We have 200 that they're going to take as their tax expense, or the base for their tax expense, because they'll never be able to deduct that 5,000. So now you take the 200 times what? Times 0.25, right? That's the tax rate they gave us. I take 200 times 0.25. That's giving me 50. Okay, now that's the total tax expense, but unfortunately, we're not done because this question is asking, well, okay, but what part of that is deferred? And the part that's deferred is going to be based on the temporary difference here, the difference between my depreciation expense that was used to generate my pre-tax accounting income and the depreciation that we took on the tax return. And so we took 40 million more on the tax return. So if you took 40 million more on the tax return and you have what, a 0.25 tax rate, that means what? I've got a 10 million. Okay, I'm just going to write in the million, I guess, here. I've got a 10 million deferred tax liability because later on, I'm not going to be able to take that as a deduction, and I'm going to have to send a check to the IRS on that, right? So my current portion is what? Is going to be 40 million, right? The 50 minus the 10 that's deferred. The current portion is the 40 million, and the deferred portion is the 10 million, right? So we take a look, and yeah, we have to break it out into its current portion of 40 and its deferred portion of 10, okay? Now, when I looked at this, I'm thinking now that I probably should have gone ahead and reversed these two questions. It would have made the second one easier, because here they're just asking me what is the, on its balance sheet, what should it report here in terms of the deferred tax liability. And so you take a look, and we've got what? We've got the 40 million difference, all right? temporary difference times the tax rate 0.25 gives me the 10 million. And remember, we said towards the end of our lecture that we always sit there and report our deferred tax assets and liabilities as non-current. Okay, and so that's what would happen. We're just asking us the classification as current or non-current. Okay, all right, good. So those two questions have the same fact pattern, just asked different things. Okay, let's take a look at this next one. We've got this Stern company had pre-tax accounting income of 45 million. Stern's only temporary difference for the year was rent received for the following year in the amount of 15 million. Not the most wonderful written question, but basically it's money that what they got this year that they went ahead and counted as income, that they would count. They got this 15,000. Let's read this question. During the current year, Stern Company had pre-tax accounting income of 45 million. Stern's only temporary difference for the year was rent received, which will actually be income for tax purposes in the okay, got me. Okay, let's take a look at this one now, and we've got this Stern Company has pre-tax income of 45 million. Stern's only temporary difference for the year was rent received for the following year in the amount of 15 million. What's the taxable income? So what's happening? Well, there's an amount, probably some sort of prepaid rent, that because they collected the cash, we have to report that for tax purposes, but we aren't going to report that for GAAP purposes until we earn the income the next year. But we have to send a check to the IRS for that now, right? Because we've received that, and they require that if we receive the cash on that rent, we have to declare it for tax purposes. So my taxable income is this 60 million. Okay, all right. Let's go ahead and take a look at the next one here now. Okay, so as we look at this next one, it's a little annoying, I guess. Okay, number 8, information for Kent Company, and they give us all this information, and they tell us the cumulative future taxable amounts, enacted tax rate. Remember, we always use the enacted tax rate. They don't give me any other rate, so that's easy enough to pick that up. And then they ask for the current portion of income tax expense. And the reason I say it's a little annoying is that, our current portion of our tax expense is always based on the taxable income. The current portion is what is the check we're going to have to send to the IRS, right? Our current portion of our tax expense is what is the check we're going to have to send to the IRS. It's going to tie to my taxes payable, right? So I take the 153,000 times the 0.25. That gives me the correct answer here. 150,000 times 0.25 gives me the 38,250. So that's one of those questions that you sit there and you start getting transfixed by all the information. Meanwhile, it's a pretty straightforward question, right? Okay, so continuing on then, you go to the next question. Same set of information in number 9 here for this Kent Company. And you look, and again, permanent differences do not enter into my calculations with my deferred tax liability, etc. And so I'm really interested here in what they have an additional, they have a temporary difference. I'll show you why I know it's additional here in a second, of 12,000. So I come down, and we already saw what the taxable income and the current tax payable is going to be, and we can see that this helps me to determine, okay, yeah, my deferred tax liability is going to go up. Well, the additional additional depreciation I have for my temporary difference now comes up 12,000. It started at 13. Now it's at 12. So if you look, essentially my deferred tax liability has come up 12,000. So I take the 12,000 times the 0.25, 12,000 times 0.25 is 3,000. So my deferred tax liability has to increase 3,000 because my depreciation I've taken for tax purposes has increased additional 12,000 during the year, from 13 to the additional 12 that we saw up there, to bring it to this 25 now of the additional depreciation. So my deferred tax liability has gone up 3,000. Now we already calculated that there's that additional 3,000 to the deferred tax liability. I do it this way. They're doing the same thing here. The difference in the amount of depreciation, that it will be a temporary difference. It will reverse in another period. They're doing it that way. I'm just looking at that 12,000 difference, multiplying that by 25%, gives me the 3,000. Okay, and so I've got that 3,000 sitting there. I know from the previous question that my current tax payable is 38,250. So the 3,000 plus the 38,250, right? The increase in my deferred tax liability plus my tax payable gives me my tax expense here of 41,250. Okay, so an increase in the deferred tax liability, or it could be a decrease in deferred tax asset, is going to increase my tax expense over and above the tax payable that I owe to the IRS. Okay, let's look at this number 10 here now, and you can see that we've got this pre-tax accounting income for the year ended December 31st, 2021 was $50 million for Truffle Company. Truffle's taxable income was $60 million, and this was a result of differences between straight-line depreciation for reporting purposes and accelerated depreciation for tax purposes. The enacted tax rate is 25% for 2021 and 30% thereafter. What amount should Truffles report as the current portion of tax expense? Now, look, this is a mean question because, look, they say that the difference was a result between straight-line depreciation for financial reporting purposes and accelerated depreciation for tax purposes. And that gets you to thinking, well, then the taxable income should have been less than the reported income. But you could have had accelerated showing more in previous years, and now the accelerated is slowing down, showing lower amounts than the book. And apparently we're to that stage of this fact that they had differences between straight line and the accelerated. So that sentence does you no good at all to be able to answer this question. All right. All you need to know here is that they had what? They had taxable income of $60 million, and my taxable income of $60 million times what? And for the current portion, it's the current enacted rate for 2021, gives me 0.25. You can see the calculation right there. The answer is A, 15 million. So sometimes just the way we might word some of these questions could lead to a certain amount of confusion for you. Okay, let's look at this number 11 here. The financial reporting carry value of Bose Music's only depreciable asset exceeded its tax basis by $150,000. So what is that telling you? Carrying value for book purposes is going to be its cost minus any accumulated depreciation. Tax basis would be whatever you have taken minus any depreciation you've taken for tax purposes. So if we have $150,000 more carrying value for book purposes versus tax purposes, that means we've taken an additional $150,000 of depreciation for tax purposes than we have for book purposes on this asset. And they tell us that that was the result of the depreciation for financial reporting purposes and accelerated depreciation for tax purposes. We've taken more depreciation for tax purposes than for financial reporting purposes. The asset was acquired earlier in the year. Bose has no other temporary differences. The enacted tax rate is 25% for 2021 and 30% thereafter. So the real test here is, what rate do I use? And I'm going to use the 30% because that deferred tax liability is going to turn around in later years when I'm taking more depreciation for book purposes than tax purposes, and I'm going to owe the IRS some additional money for the fact that now I'm not able to take that additional depreciation. So I pick up, and I knew it was going to have to be this number times one of these two numbers on this question in order to get the answer. Okay, and of course I had to realize that it was a liability, and so I go ahead and multiply that by 0.3, and that gives me the answer here, 45 million or 45,000, I guess, deferred tax right there, deferred tax liability in this case, because I've taken more depreciation for tax purposes than for book purposes. Okay, let's look at this next one. Gadia Foods reported $940 million in income before taxes for 2021 in its first year of operation. Tax depreciation exceeded depreciation for financial reporting purposes by $100 million. Okay, so we got more depreciation for our tax. The income tax rate for 2021 was 25%. But then the enacted rate for years after 2021 is 30%. And so we want to get the deferred tax liability here at December 31st, 2021. And again, because that 100 million difference, right, 100 million, is going to reverse in future years, we would go ahead and use the future enacted rate. Again, it's got to be enacted. And so that gives me a $30 million. You can kind of see the calculation down there. I'm not really adding much by writing that in. $30 million deferred tax liability based on that enacted future rate when that difference will reverse. Okay, good. Let's look at number 13. I want to take a second to correct something that I said during the lecture when we went through the slides. I stated that they had eliminated the net operating loss carried back as part of the Tax Cut and Jobs Act, which was true, but then they put it back here sometime because of some of the issues with the COVID relief. And my sense is that once we kind of get past this period, they'll probably go ahead and go back to the old rule. So even though you can still do loss carrybacks under the revised law from the Tax Cut and Jobs Act, in this class we'll only deal with loss carry forwards. We'll only deal with loss carry forwards, okay? All right, so I just want to clarify that because I had forgotten that they had suspended what they had done the year before that, or the years before that, a couple years before that, in the Tax Cut and Jobs Act. That's why I'm not a tax guy, because I don't like to keep up with the flip-flopping of Congress all the time. So I apologize for misstating that. But in this class, we will always deal with net operating loss carry forward, okay? So you look at this question here, number 14, and we say in 2021, Bodily Corporation reported $300,000 of pre-tax accounting income. The income tax rate for that year was, oops, sorry, I'm jumping to 14 and I want to do 13. 13. Assuming no other deferred tax items exist in a particular year, a net operating loss carried forward will be shown on the balance sheet at the end of the net operating loss year and what happens. We know that current is wrong. So anything staying current is not right because we know that our deferred tax liabilities and assets are non-current. It is not going to be what? It is not going to be a receivable under current assets for a tax refund because we essentially haven't had that future income yet to set off against set the net operating loss against. So it's not a receivable. It is a what? Deferred tax asset. We're thinking that in future years, we're going to have what? Future income that we'll be able to shield from tax using that net operating loss. And in this class, it'll always be a net operating loss carry forward. Okay, let's look at number 14 now. In 2021, Bodily Corporation reported $300,000 of pre-tax accounting income. The income tax rate for that year was 25%. Bodily had an unused $120,000 net operating loss carry forward from 2019 when the tax rate was 30%. Bodily's income tax payable for 2021. Now look, what the tax rate was when we had the loss that we're now using to shield our current year income against taxation with this net operating loss carry forward that's anticipated in this question is of no consequence. So we have $300,000. We have what? We have an unused $120,000 loss carry forward. We use the current year's tax rate, then gives us income tax payable of $45,000. So you go by whatever the rate is at the time that you're using that deferred tax carry, that not deferred tax asset, but well, it would be a deferred tax asset they're using up at that point. But here they were just asking us what is the tax payable based on the fact that we have $120,000 net operating loss that we can offset our current year income against. So we use the current year's tax rate. Okay, and then looking at number 15, wrapping up this practice midterm, before considering a net operating loss carry forward of $80 million, Pharma Corporation reported $200 million of pre-tax accounting taxable income for the current year. So we got this $80 million carry forward that we're going to be able to use. The income tax for all previous years had been 30%. On January, I'm just going to cross it out now. On January 1st of the current year, a new tax law was enacted, reducing the rate to 25%. So we use the rate that is in effect at the time that we use the carry forward. Same concept that we looked at last time in the previous question. So $200,000 minus the carry forward gives us taxable income of $120 times the current enacted tax rate of 25%. Gives us $30 million. Okay, good. I think you get a good sampling of the different topics there with this question. So hopefully that was helpful for you to help you see how some of those were answered.